Patrick Wolff of Grandmaster Capital had a bang-up year last year, a fairly new fund with some outsized performance. I'm joined now by Patrick at the GAIM Hedge Fund Conference here in Florida. Good to talk to you, Patrick.
Hi, Brenda.
Now, you actually just started the fund not that long ago.
Yeah, 2 years ago.
And you picked a good time to start because you've done well. The equity market did well last year. Are you as upbeat on stocks this year?
Well, I think there are very good opportunities. It's always, after a really strong year, it's always very dangerous to assume that everything's going to play out the same way this year, and we don't know what we don't know.
Yeah.
So who knows what's going to happen. But I do think that for the longer term, stocks are a very good place to be invested, and they offer great opportunities both long and short.
You were speaking at the panel earlier about valuations, and you were challenged since stocks aren't really that far from their all-time highs, about 5% or so. So what makes the valuations look compelling to you? What nuances are you looking at that perhaps others are missing?
Well, if you just look at the overall market, you know, the S&P 500 is where it was maybe 14 or so years ago, but of course the companies are earning much more. So relative to the earnings power, the companies are much cheaper. I think if you look at the market as a whole, the market valuation looks very reasonable, but there's, you know, the market is made up of a lot of companies, and you only want to own a few that you really understand, and we're finding plenty of opportunities. I think that's the key.
And where are the opportunities? Are there individual sectors you're looking at, or
no? We just look for good companies that we can understand. I mean, I realize that sounds fairly boring, but you know, the devil's in the details, obviously, and digging into those details is what we do. But I think there are good opportunities in plenty of places. Broadly speaking, I think larger caps are probably cheaper than smaller caps, a reverse of certainly of where things were a decade ago.
How worried are you about what's happening in Washington and what will happen over the next couple of weeks with the fight over the debt ceiling? Will that affect the way you think about managing your portfolio?
I'm not very worried about what's happening in Washington. I think the risk of Washington is that we get something really dysfunctional, something really that would be sort of very, very bad mismanagement. And, you know, we sort of tiptoe up to the line, but every time we do that, we seem to pull back, and we seem to be pulling back a little closer, a little sooner than we had done before. So I don't think the risk is very high. I think there is a risk. I think you have to watch it, but I don't think that's really something that should keep people out of the market.
Now, you're an equity guy, but I'm going to ask you about bonds because there is a relationship, obviously, and we know that retail investors have been piled into bonds all the last year. Do you think we're in a bond bubble?
I don't think we're in a bond bubble. I do think that the interest rates of government bonds today do not offer an appealing return to people who want to make an economic return on their money, right? So what I mean is the interest rate of a bond is set by what you think is going to happen to short-term interest rates. I think present interest rates make sense given what you might think is going to happen, but I certainly don't think they offer a very good return. More broadly, I think the 30-year bull market in interest rates is essentially over. Our adult lifetimes have been lived in this massive bull market in interest rates, and I think the next 30 years just can't possibly look anything like the last 30.
But won't that impact equities?
Well, yes, but equity valuations are much more reasonable. So if you went back a dozen years, you could have said, well, interest rates at 5 or 6% don't look that appealing relative to where they were in the 80s. That's true. But of course, stock PEs were at stellar levels. Now you have PEs that are very reasonable, and you have rock bottom interest rates. So interest rates can come back up by a few hundred basis points, and stocks still look attractively valued.
Tell me a little bit about what you're seeing in terms of your business, raising capital, interest from perhaps a broader clientele than what we've seen in the past couple of years.
Well, I think certainly for a fund with a couple-year track record like us, groups that are a little bit more nimble, oftentimes family officers or high net worth individuals are the kinds of people that are sort of ready to invest in a fund with a couple-year track record. At the same time, we're having great conversations with people with perhaps a little longer process, but you sort of have to knock on the door and start that conversation earlier. I think, you know, there's a lot of opportunity out there. I think really what matters is doing a good job for investors. If you do that, everything else follows, so that's what we're focused on.
You had a good year, but what was the biggest mistake you made last year?
Wow, so many, and I have to pick one.
Just pick one.
Let's see. I would say, although we remain bearish over the long run on China's economic prospects, we certainly underestimated the degree to which the government there would continue to sort of turn up the crank on fixed asset investment and keep the economy going. Also, we certainly underestimated the really bullish implications of the monetary policy of sort of the policy levers that Draghi was pulling in the middle of the year. Fortunately, from our perspective, we were right that the United States remains a good place to be invested, and we're just going to do the best job we can picking stocks.
And you're long on the 49ers, is that correct?
Yes, I am. I'm very long on Kaepernick. I think he's got great prospects.
All right, we'll see if you're right. Patrick Wolff, thanks so much.
Thank you.
I'm Rhonda Schaffler. This is Reuters.